All right, good morning, everybody. We're back at it for another week. Band in the green, 1.5%. That's a quick turnaround. Same with Hong Kong. They were down along with others, and I would caution when you see this. Last I saw, the Nikkei was down considerably, and I don't think that changed. So, real quick, I'll just check. This page, I've seen it be wrong before when it comes to some of these other markets around the world. And yeah, no, they're still down. So just ignore those two. It's red around the world. There's been a lot of hype about getting some rate cuts, expecting that they're going to come in and play save a hoe and a plunge protection team stepping in to bring us back up. I would caution anybody expecting that. While the president is banging the drum and saying that the Fed should cut, the Secretary of Treasury, who replaced Yellen, Scott Bissett, has a plan. And part of that plan is to wean the market off of government stimulus and not expect the Fed to go in and cut rates every time we're in trouble. So, can they cut? Yes, absolutely they can. But will they cut at this level, or are going to have to go down another leg lower? And even if they cut, I don't think that it would help all that much, right? Because normally when they cut, it's because we're in trouble and it's due to something like jobs or some kind of fiscal policy. But you can't juice our way out of this one, right? The Yeah, it just wouldn't fix the problem. We don't really have a lot of economic events on the table today. We have some auctions in the front end and consumer credit, a couple of Fed speakers chipping teeth. I would say headlines are going to be the dominant aspect for today. So anybody coming out in the administration making official statements or the president making any official statements, that could be more impactful to the market today than any scheduled economic events that we have, because we really don't have much today. It is worth noting a Monday gap down and how fantastic a Monday gap down is if you're looking for capitulation lows and a flip back up, even if it's just a flip for like a dead cat bounce. So if we zoom in here a little bit, we don't need this line anymore, but I'm just going to move it over just to get it out of our way and keep it here. This is a hollow red candle. And what that means is while we closed here and we closed here, so we closed lower than the previous day's close, that makes it a red candle. We actually opened here and rallied before we closed. So in a regular red candle, which is solid, we would open, fall, and then close, and it's a solid red candle. Because we opened and then rallied and then closed, it's a hollow candle. These are called trend candles, so that it's not just, green and red. It's also whether it's hollow or solid. Same thing with the blue ones, or probably green on your computer. They're hollow because we opened, rallied, and closed, but they're solid if we opened, fell, and closed, but that close was higher than the previous close, so it was still bullish or still green, blue. So look at the way that this drop happened back in August of last year, right? 3 significant days of just massive violence and drop. And then we turned around and started to run that back up, right? And that was a weekend. We went from 8.2 to 8.5. So from a Friday to a Monday, big sell off, big gap down, and then we turned it all around and ran back up again. Now, this one actually had a pretty decent outcome. They don't always, because that isn't really one of the criteria. We're looking more of like a dead cat bounce sort of a situation. Here's another one, not quite as good as that last one, but you can see 3 days of significant selling and then a big gap down and a rally back up, right? Now, this one I don't believe was a weekend one. Yeah, no, that was midweek. That was actually Thursday into a Friday. But a gapped down Monday and a gap down from the lows too, rather than a gap down from the highs, which is completely different. Same situation here, 3 days, hollow red candle, implying that we ran back up after opening way down here. Another one. Look at the gap down on this and then the rally back. So don't let this gap down, freak you out. We're in a bad spot. We've been in a bad spot. This isn't a surprise. And that's one of the things that you really want to keep your focus on. Markets do not like surprise. But this isn't a surprise. We seen this coming. Everybody knew it was coming. They telegraphed it really well that, hey, we're going to really screw you guys over. Cheers, have a drink, right? It's not like we didn't see it coming. So here we are now. If we zoom out a little bit, you can see where I've got my line. Probably help if we were on a weekly. April 2024, low. It's this halfback 48.32 cog line that's really worth that. And that takes us back right there. Thinkorswim's a little laggy today. All right, so setting us up like this gives us this halfback. 48.32 cog line. We're back to the put wall. Then we've got the call wall, and then we've got zero gamma and volatility trigger. I was looking around trying to find the last time we had the call wall underneath the volatility trigger and zero gamma. I haven't found anything yet. I know it's happened before. I'm just trying to find some background with that, but it's not a common situation. So I'm hoping to get more information, some more depth there of, what happened last time? How did it work out for us? What did the market do? Because it's a unique signal, to say the least. So it'll be interesting to get some clarity on that. Plus, the AM founders note isn't out yet, and that would obviously shine a light on things. we've still got a significant elevated volume. This number is generally around 60, right? If we went back looking for an average over the years, 60 would be about average. So when we get around 100, obviously we're well above average. 488 is so far past the average that it doesn't even compute, right? This is significant levels of overnight trading. These are voodoo lines of note worth a second look at least. Just clear away all the stuff that was there to see if there's anything. These red lines can be mistaken for spot gamma lines, and then that can just be a real mess. Those red lines are the most important or the most significant lines in the voodoo set. So just wanted to clear those spot gamma levels out, make sure we weren't getting red lines crossed. 52.45 to the upside and 4,800 basically to the downside for the forest. All right, we're back inside the ADR. Generally speaking, if we get to one side early enough, we can go to the other side by the end of the day. This isn't about being bullish or bearish. It's more of a reflexive action. If you just think about the waves in the ocean, they go up, they go down, they go up, they go down, right? It doesn't mean that we're going to get some crazy tsunami tide. It's just the way that the ocean moves. It's the same way with markets. We go up and down, whether we're bullish or bearish, it's still a two-sided market. So it's more likely that we hit the upper edge simply because we've hit the lower edge. And we hit it early enough in the day that we still have time to get up there. Having said that, though, that logic and those statistics don't account for things like a significant, massive gap down like we have here. Now, on the one hand, this gap wants to close. And we were just talking about gap down rally days from the lows. A little bit like a capitulation low. So it's absolutely possible that we could go up and hit this lower edge, which still wouldn't close the gap. And that would get us close enough to the gap that, like a magnet, we would just get drawn up in there and we would close that gap. It's possible. But the channel itself becomes an issue. That is the channel. Just getting into it, getting through the midpoint of it, getting to the other side of it. Now, some analysts are going to say that it's the low of Friday that really matters because that's how they do gap closes. That'll be 50.74. Me, I'm a little more particular. If we closed at 50.96, then to close this gap, we've got to go back to where we closed, and that would be 50.96. Either one of those. It's very likely that the central pivot range for today is broken just because of how far we gapped for the open. This is the channel for today. It's wider than the one that we had on Friday. A wide channel implies that if we break out, it likely doesn't stick. It's lower than Friday's. That's bearish. Price opened underneath it. That's also bearish. Everything is below the weekly expected move, and that's bearish. It's not a surprise, right? A little bit of Captain Obvious. We had two MDPs before today, right? It's a missed daily pivot. If you want to know more about that trade logic or even the analysis of it, you can always just hit Google. It's not my trade strategy. I don't trade it, but it is insightful, especially when doing some analysis. So today so far, we also have an MDP. It won't count until tomorrow. And we've made it to an S2. So if we were looking for a reversal, that would be a place to look for it from, right? Get from an S2 to an R1. R1 would put us around 53.11 cog line. Yeah, we got this distribution through here. That lines us up at about 5,200. So even if we can get that gap closed, if we continue to try to rally beyond that, we're going to get into this. 5,200 is going to be a significant level to get through. Not really a lot of help on this at this point. We don't have a classic shape. We don't have any volume node within our area that would bring this in, and we're not going to get to the candles that gave us this point of control until maybe late today or into tomorrow. Even when we do that, it's likely to drop down into this zone with these candles. So maybe we come in tomorrow and we've got the point of control somewhere around that 5,600 area. $56.32 cog line. Maybe. If not, then by tomorrow afternoon, we'll see the point of control move down. But it's not going to come down here, and we don't have a significant build out of volume at this level. We've got a new VPOC overhead from Friday. $51.75. So if we get this gap closed and we continue to push, we've got to get through that before we can get to that 5,200 area that we're talking about. You kind of see it in the distribution from Friday. It's not a classic shape, like a classic D. Instead, we've got all of these different distributions. We'd have to work through every one of those levels one at a time. The high volume nodes. All right. We're almost 8.5% away from the 10-day moving average. When we think about having gone too far, too fast, this is a really good representation of that. Rate of change is too extreme. We've traveled too far. We are going to move back in the other direction. We've already started moving back in the other direction, right? That's not much of a surprise. How much we get or how long it lasts is a completely different discussion. Getting 4.5% out of it wouldn't be too big of a surprise. If you look at where we're at say a -2.5, and we're talking about a +4.5, then that would give us +2 by the end of the day ish. Not talking about coming out of the lows that we're in or solving the problem or getting back, up into the 5600s. We're just talking about a significant bounce that at the bare minimum could see us somewhere around 53. But it's broken, right? So that is what it looks like when you travel too far too fast. Least squared methods, dot plot, statistics, linear regression, whatever model you want to use, we've traveled too far and we're due a pullback. More than 10.5% below the 10-week. Again, too far, too fast. We're due for some sort of pullback. On this level, though, the pullback would be more sustained, right? It wouldn't just be a flash overnight. It would last for a few days, maybe even a week. It still wouldn't be us coming out of this bear market and, having everything good again. Just a bounce. There's been a lot of talk about the margin calls in gold, and I don't know. I remember the COVID collapse. I remember them selling gold because of their margin calls and how they were hit, and it was a global crisis, and everything sold, right? There was no safe havens, there was no defensive sectors. Even the defensive sectors were getting sold because that's supposed to be where you can hide in bear markets or in bad times. But when the squeeze starts to come even on those, then it's a race to get out as fast as you can before the other guy can. And then you get the crisis even in defensive names. If you look at gold and you think about that bear market of 2020, that or that capitulation that we had in 2020 during COVID, this doesn't look like much. So isolation, a few really over leveraged firms, maybe they were liquidating, maybe there was a margin call. I would say it isn't systemic yet. It isn't spread out. Because look at that. That's COVID, February and March 2020. That's what it looks like when you get margin call and banks sell their gold. And then look at that. 1.68, 5.5%. 5.5% is pretty big in a week. $11.75, twice as big as the week that we just had. So I'm not saying there wasn't any margin call. I'm just saying that wasn't significant, right? If it gets significant, it will get a lot worse, and we're not there yet. And that's just for a recognition of funds and firms needing to liquidate their gold because of the increased margin, which there are charts for that, which I'll end up posting those in the chat later. But on TradingView, you can bring up, the leverage and see if the banks are getting over leveraged and if they're getting margin call. There's a lag to those charts, however, right? Because a lot of that is self-reported. This is what we want to keep our eye on right now, and it's those defensive names. This is supposed to be where everybody goes and hides. Until we start to get a run on those three sectors. You start to get a run on those three sectors, and then it's a race for the door of who can get out first. And that looks a bit panicky compared to what we've seen. That's how much worse it gets. But if we're looking for capitulation signals, keeping your eye on gold for, a 10 to 12% drop, and these staples, that'd be a good tell. All right, Bitcoin is down almost 9%. China's down 5.5%. Chip sector is down 3.75%. Right behind that, expanded tech, the Mag 7 at 3% to the downside. Just your generic tech, more than 2.75%. Solar, healthcare, banks, financials, consumer discretionary, energy, cloud. It's almost to the point where it's easier just to ask, well, what's up this morning? The VIX and nat gas. Not much of a surprise there. They don't want to rally on nat gas, right? Now, one of the things that we've had is bonds up, yields down, and we're seeing yields start to rise here a little bit. So if we get yields rising up, that'll help with this pop back to kind of close the gap that we've been talking about. So bonds down, yields up, that'll help try to get this gap closed. If yields stall under 4 and can't get back above, then we start to fade off in yields. We're likely to see bonds continue that drive to the upside, and we're likely to see the S&P, the NASDAQ fail to get the gap closed. There has been a few articles about financial stability globally, and the risk right now is that something can break. right? If you remember, a really big fund, something like the crypto exchange that blew up, right? And that dude that went to prison, they were just doing shady stuff. But there was this global crisis just on that one single event. The 07-08 financial crisis turned global, cascading failure and just really no safe haven. So while this is a bounce spot and everybody is looking at it and telling you why it can bounce and how it can bounce and how far the bounce could be, and it doesn't have to bounce, right? So kind of keep that in mind. If something breaks, and so far, none of this is from something breaking. This has been really organized and efficient, and it can get a lot worse. So when you're trying to figure out what a lot worse would look like, just start with Friday. It's a 6.5% move, and set it from Friday's close. You're looking at 47.36. Now, if we want to be, a little less generous, start it at where we opened Sunday night. That's 46.50. That's a one-day move, and it's within our current market endeavors rather than looking back through history 5-10 years ago and arguing, oh, it was different back then. All right, well, how different was it from Friday? So with the range that we have this morning, and we've already started to do it, once we get above the open from Sunday, we need to keep it. We need to get that breakout, close above, and stay out of this range, which we didn't do, but the market's not open yet. So let's get into 9:30. 2, keep above the midpoint, 49.19. Just call it 49.11. For me, it's the cog line. It's close enough. We got to keep the mid. 3, if we don't keep the mid, we got to keep the low, 48.32 cog line. Really don't want to go below that level. If we do, then we start expanding to the downside, and that would be our next stopping point, 47.92 cog line. Beyond that, the next mid, 47.50. It's a nice round number, but 47.44 would be 50% of this move right there. $46.50 would be 100% of that move. And it's also the measured move that I took from Friday and I marked down from where we opened Sunday night. Get the same answer, 46.50. So if things really do start to get a little ugly out there today, if we don't bounce, and this isn't the capitulation low that we're looking for, 46.50 is a really good starting point to expect a pause on the day. At that point, we can look to see if we're going to hold the line or leg down from there. It's not all doom and gloom, by the way, because we're not seeing panic. So, as at least there's that. Little bit of precious metals this morning. See that silver was up. It looks like it's dropping back out again, but we were getting a little bump in silver. All right, guys, this is what I've got. Keep your eye on the headlines and the measured moves, treasuries. They're going to be your biggest assets today to try to spot if any of this is changing, if it's going to get better or it's going to get worse really fast. Treasuries, headlines, and the clock. Be careful, be safe. I'll see y'all tomorrow.